Today, we are going to break down one of the most important documents in business, the income statement. Now, I know that sounds kind of boring, but trust me, it's not just a spreadsheet. It's actually a story. It's the story of how much money a company makes, and way more importantly, how much of that money it actually gets to keep.
But before we dive in, let me start with a puzzle. How is it possible for a company that sells $717 billion worth of stuff to be 5 times less profitable than a company that sells $216 billion? I mean, that just doesn't sound right, does it? More sales should equal more profit, but as you're about to see, that's not always the case.
And here they are. On one side, you have Amazon, a global behemoth, bringing in a jaw-dropping $716 billion. But look at that net margin, only about 10.8%. Now look at NVIDIA. They only brought in $216 billion, but their net margin, an absolutely staggering 55.6%. This right here is proof that the money coming in the door is a totally different story from the money left at the end of the day.
So, how do we make sense of this? Well, the answer, the entire story, is hidden in plain sight, right inside the income statement. And once you learn how to read it, you can understand the real engine behind any company you can think of.
The best way to think about it is like a waterfall. We're going to start at the very top with all the money a company brings in. Then, with each step down, we're going to subtract a different kind of cost. What's left at the very bottom, after everything is paid, well, that's the ultimate prize, net income. So, let's start at the top.
First up, we have revenue. This is what you hear people call the top line. It's the big, flashy number everyone likes to talk about. It answers the most basic question of all. How much money did customers actually pay the company?
So revenue is just the grand total of everything a company sold. Think about a company like Apple. Their revenue is every single dollar from every iPhone, every Mac, every App Store purchase, and every iCloud subscription, all added up for an entire year. It's our starting point for the waterfall.
Okay, now for our first subtraction. We take that big revenue number, and we take out the direct costs of actually making the products. What we have left is called gross profit. And honestly, this is where the story starts to get really, really interesting, because this number shows us how much power a company has to price its products.
We usually look at this as a percentage, which we call gross margin. A high gross margin is a huge deal. It means a company can charge way more for its products than it costs to make them. It's really the first big sign of a powerful brand or a unique product.
And this right here shows there's no single right way to do business. Look at NVIDIA, a massive 71% gross margin. Why? Because their AI chips are so advanced and in such high demand, they can basically name their price. But then you have Costco with a razor-thin 12.8% margin. They're doing the exact opposite. They sell things for almost no profit on purpose just to get you in the door to buy that membership, which is where they make all their money. Two brilliant but completely different strategies. All right, let's keep going down our waterfall. The next thing we subtract are all the costs of, running the whole show. This is what we call operating expenses. Think research and development, big marketing campaigns, and all the salaries for the folks in the office.
And this is where we find a really cool tool for analysis called the margin gap. It's just the difference between that gross margin we just talked about and the new operating margin. And this gap tells you everything. It shows you exactly what a company's priorities are, where it's choosing to spend its money to win.
So let's go back to Amazon for a second. They start with a really healthy gross margin of over 50%. So for every dollar of stuff they sell, they make about 50 cents after paying for the product itself. Pretty good, right? But watch what happens next.
Bang! After you subtract all the costs of running that massive operation, Amazon's margin just plummets, all the way from 50% down to 11%. That huge drop, that's the margin gap. So the big question is, where did all that money go?
It went into building one of the most powerful competitive advantages or moats in business history. That 39% gap is billions upon billions of dollars being poured into warehouses, delivery trucks, and the giant server farms that run Amazon Web Services. It's a totally deliberate strategy. Give up profits today to build a business that nobody can touch tomorrow.
And with that, we have finally arrived at the bottom of our waterfall. After we've accounted for all the costs of making things and running the business, we just have to subtract a couple more things, like interest payments and taxes. And what's left over? That's net income, the legendary bottom line.
There's a famous saying in business, revenue is vanity, profit is sanity. Having a huge sales number is awesome for bragging rights, but at the end of the day, the only thing that really matters is how much of that cash you actually get to keep. And this is where we find out.
And we measure it with something called net margin. It's the simplest and maybe the most powerful number of all. For every single dollar that comes in the front door, how many cents make it all the way to the bottom as pure profit? This finally solves that puzzle we started with.
Look at this. NVIDIA is an absolute profit machine. For every dollar in sales, an unbelievable 55.6 cents drops straight to the bottom line. It's just incredible. Now here's Apple, which is pretty much the gold standard for a premium company. They keep about 27 cents of every dollar, a fantastic world-class number that shows you the power of their brand.
And then you have Costco again at just 2.9 cents of profit for every dollar of sales. See, this proves their entire business model. They don't make money selling you a rotisserie chicken, they make money selling you the membership that lets you buy that chicken.
So you see, it's never just about high margins being good and low margins being bad. A 55% margin isn't automatically better than a 3% margin. It's about understanding the story that each number tells, the story of a company's strategy and its vision for the future. And now, you have the tools to read that story for yourself.
The analysis we walked through today comes from the incredible research platform Finstill. And by the way, that's pronounced Finstill. They do an amazing job of making this kind of high-level analysis accessible to everyone.
So if you enjoyed this and want to keep learning, definitely follow us for more explainers just like this one. And you have to go check out their site, ffifinstill.com. They have over 300 free learning concepts that break down everything you could ever want to know about finance and investing. So I'll just leave you with this. You are now officially equipped to look past the big headlines and read the true financial story of any company out there. So the only question left is, which company's story are you going to read next?